Welcome to The Explainer. Today, we're diving into a surprise announcement out of India that absolutely rocked the stock market and really has everyone questioning the entire future of the tobacco industry there.
So picture this. Not too long ago, investors in one of India's biggest companies, ITC, woke up to see this number staring back at them. A massive, nearly 10% drop in a single day. You can bet that set off some serious alarm bells.
I mean, this wasn't just some bad day at the office. This was ITC's worst single-day plunge since 2020. We're talking billions in value just poof, gone in a matter of hours. And the big question on everyone's mind was, what on earth just happened?
Okay, so let's get right into it. The trigger for all this chaos, it was a surprise announcement from the Indian government. A policy decision that sent, and I mean this literally, shockwaves through the entire industry.
And look, this wasn't just some minor tweak to the tax code. No, this was a massive policy shift. The government is bringing back a specific kind of tax that completely changes the math, the fundamental economics of the cigarette business in India.
So what does this new tax actually do? How does it work? Let's break down what we're calling the new cigarette math.
So the government brought back something called an excise duty. Now, this is a tax that's charged right when the goods are made, in this case, per 1,000 cigarettes. And here's the kicker. It gets slapped on in addition to all the other taxes that already exist, like the GST.
Now this is where it gets really interesting. This isn't just a flat tax. The government got pretty clever with this one. They've structured the tax based on, get this, the physical length of the cigarette.
So here's the new rule of thumb, and it's super simple. The longer the cigarette, the higher the tax. That means those premium, king-size brands, the ones that are a huge source of profit, they're the ones that are going to get hit the hardest. Suddenly, size matters in a whole new way.
So you've got to be asking, why? Why would the government roll out a policy that they knew would cause this kind of chaos in the market? Well, the answer is a really tricky balancing act between public health and, you guessed it, government revenue.
The official rationale from the finance ministry basically boils down to three things. First, and most obviously, improve public health by making smoking more expensive. Second, bring in more cash for the state. And third, to try and clamp down on tax evasion, which has always been a big issue in this industry.
And to give you some perspective on that public health angle, even with this big new tax, the total tax on cigarettes in India is still only about 53%. Now that sounds like a lot, but it's actually way below the 75% benchmark that the World Health Organization recommends if you're serious about getting people to quit. But of course, a policy this huge is never just about the numbers. It's not that simple. It creates these massive, complex ripple effects that spread across the entire economy and, really, across society itself.
I mean, for countless farming communities, tobacco isn't just another crop. It's what people call green gold. It's a lifeline, a vital source of income that holds entire communities together.
And this really gets to the heart of the debate, right? The public health goals are great, nobody's arguing that. But experts are raising some really serious red flags. They're asking, what about the livelihoods of the farmers and the factory workers? And here's a big one. If you make legal cigarettes too expensive, do you just end up driving more people to a much more dangerous, unregulated black market?
So, with such strong arguments on both sides of this issue, it's really no surprise that the financial world is completely divided on what this all means for the future.
You basically have two camps. You've got the bulls, the optimists who say, look, ITC is a giant, they're diversified, they can handle this shock, and hey, maybe this stock drop is a great buying opportunity. But then you have the bears, the pessimists, who are saying, nope, this is just the beginning. Tighter regulations, higher taxes, this is going to squeeze their profits for years to come.
And you can see that split right here in the analyst ratings. I mean, yeah, the majority are still saying buy, but you're starting to see the cracks. Some major brokerages have already downgraded the stock to hold, and they're slashing their price targets because of this new tax. So, at the end of the day, the key takeaway here is just uncertainty. The market's knee-jerk reaction was fast and it was brutal for sure. But the real long-term impact on profits, on how people actually behave, and on public health, well, that's still a huge question mark. And that really leaves us with a final provocative thought. In this complicated dance between public health goals, economic realities, and people's actual livelihoods, how does a country decide what the right price to pay really is?